it's important to not do that. It's important to not just look at whole life, not just look at the illustration and say, hey, that's really cool, I want that. Well, that's not what you're getting. You're getting the process of banking, and it's really easy to forget that. Hey guys, welcome to the Sound Banking Podcast. This is Kyle Reese and with Raymond Ward. And today we're going to be talking about creating the entity. And this is on pages 36 through 39 of Becoming Your Own Banker. And before we get started, I just want to say you got to read these pages like 10 times each to really understand what's going on here. There's a lot of meat and we're not going to be able to cover everything. But one thing I want to say before we dive in is this section is about mindset and classification. Even though it does get into the weeds on how to properly build a whole life policy for infinite banking, there's a lot in here that that can get you distracted and think only, let's think about the vehicle. Let's think about the vehicle of whole life insurance. Remember, when we're creating the entity, we're creating a banking system. And banking systems can look different in different situations. And we just won't, it's important to not get distracted or lose focus that banking is a process. And just because we're going to be talking about the whole life, the vehicle, don't lose sight of the fact that banking is a process. So anyways, yeah, go ahead, Raymond. Do you have any thoughts?
Yeah, I mean, we're classifying what life insurance is in this discussion, and really, I've come to start to talk about how this whole process really isn't even about life insurance. It's really about the banking function. So we don't want to get lost necessarily in all of this. Between 36 and 39 pages. But yeah, the classification is really what seems to be important in this area. Would you agree with that?
Yeah, absolutely. And so with life insurance, a lot of people will ask me, okay, so what is the value of life insurance? What is it? And why do they care so much about the underwriting process? And some people think that they should do more underwriting. Other people get bothered at the fact that they're doing any underwriting at all. And I think it's important to remember that whole process is really, it's risk of you're pooling together a bunch of resources to avoid risk or to mitigate risk. And in order to do that correctly, you have to understand where the risks lie. And certain people have a higher risk of dying sooner than other people do. Some people are going to live to 110. Other people are going to live to 40. Understanding where the balance is and how much to charge for life insurance is really important. So when we're creating a life insurance policy, or I should say when the engineers are designing life insurance policies, that's what they're going through is what is the risk that this person is going to die, and what is the risk that they're not going to die, right?
Right. Yeah. It's about protecting themselves, right? Risk management. Adverse selection is what they're trying to stay away from.
Right. And it's funny to me that some people get all hung up that insurance companies always come ahead. Well, yeah, insurance companies are always going to win because they are pooling everybody else's resources together and they are absorbing all of the risk of the negative or the negative outcomes that are inevitable. So in order for an entity, a company to absorb that much risk, shouldn't they come ahead? Shouldn't they end up ahead? Of course they should end up ahead. That's a huge risk.
Yeah. But it's like any other business. They're in the business to make money. Bottom line, they're not in the business to take advantage because they're actually giving you because of this, you know, selection process that a person would go through, you know, getting underwritten and all that, they have a really good idea when you are going to pass because, I mean, they've gotten so good at it.
Mm-hmm.
They have a really close, you know, within 2 years, could you say 3 years, probably either
Yeah, yeah.
side of a particular age,
10 minutes.
which would be uninsurable.
Yeah, right.
But they are in the business of making a profit, but they're doing it through the pooling of all this capital. It's something that we couldn't do as individuals.
Right.
The risk of dying early and not creating that income for your family, we can't insure against that by ourselves. And so they're in the perfect space. They're experts at risk management. They're experts. You know, there's nobody better than them, really, because they've been at it for so long.
Well, let's make sure and clarify that statement. There's nobody better than mutual life insurance companies at
Yeah.
this because
Yes.
they have a very big vested interest in a safe bet because it's all private, it's all localized, right? As compared to a stock owned life insurance company who could just go raise money if they did something wrong.
Yeah. 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 Thank you for clarifying that. I guess I always kind of just assume that we're talking about, what happens with assumptions.
Oh yeah. Yep. And so
Um,
when
yeah.
people die, right there, that's the mortality, and engineers are going to design policies for a specific mortality, like based on mortality tables with expectations that people are going to die during certain times. Engineers always overbuild things, they overdesign things, they're always on the safe side, and so when the actual experience of the company is less mortality than planned for, you have a profit. You've charged a certain amount of premiums to everybody. Now, not as many people died as you were planning on. There's a profit there, and you could share that, and they do share that. Mutual life insurance companies, they share that profit back to the policyholders or the company owners in the form of dividends. And so it doesn't really matter whether your life expectancy is age 65 or age 105. It doesn't matter if you're a table D or a table A or super preferred, because regardless, you're part of a company that when you pay premiums, they are over designing the entire system and they will send back dividends because it's over designed. It doesn't matter how soon you're
Yes.
supposed to die.
Yeah. So they're shooting at a particular target, to be able to pay the dividends. But if they have better than expected, is what you were saying. If they have better than expected, then the dividend is going to be larger than they expected, or could be.
Mm-hmm.
They could share it, and they probably will. Um, so that's a really good point. That, yeah, when they hit their mark, or even better, where there's less death in a particular year, they've made more money. Um, yeah. So
Well, let's right before hopping into the section on how exactly these policies are designed. At the kind of the right hand side of page 37, halfway down, Nelson says the whole idea of infinite banking concept started with the realization that there is a huge amount of nonsense going on in the marketplace because of the misclassification of things. And he goes on to talk about the Spanish people coming to America or South America and discovering a plant, the potato, and then taking it back. They were looking for gold, but they discovered the potato. But the annual sales in potatoes now are worth more than, let's see, it says the value of 1 year's crop of potatoes in the world now exceeds the value of all the gold found in the Western Hemisphere.
Hmm.
Um,
So they did find gold.
yeah, they did find gold. They just didn't know it because they had such a narrow focus on what exactly they were looking for. And I think the reason why Nelson talks about this is because people come to the infinite banking concept thinking, this is what I want and this is how I'm going to get it. And they're not necessarily fully open to some of the imagination, some of the conceptual stuff that he talks about in Becoming Your Own Banker. So they miss it, right? And it's important to not do that. It's important to not just look at whole life, not just look at the illustration and say, "Hey, that's really cool. I want that." Well, that's not what you're getting. You're getting the process of banking, and it's really easy to forget that. It reminded me of in Think and Grow Rich when he says, "More gold has been mined from the brains of men than has ever been taken from the earth." There's so much abundance in our
Hmm.
thinking, in our mindset. And if we can just tap into that and recognize that what we're about to talk about, the way that whole life policies are designed, that's just a vehicle to unleash the imagination, to unleash the gold that's already in your mind.
Yeah, yeah, and becoming your own banker is really what this is about, right? That you have the ability to act like a banker, um, and if you don't understand what the problem is, meaning the lack of the banking function, like if you have no banking function in your life, what does your life look like? Does it look like a struggle?
Hmm.
Is it are you on the edge all the time? And I would like to just venture to say that the bank, when you create the banking tool, um, you move away from the edge.
But does it feel like you move away from the edge at first?
Oh no, not at first. No, because it does. There is, like all business, and this is a bit. You're starting a business. It takes time to build profit. In other words, you're putting capital in, and in the first 1, 2, 3 years, put in 10. Just as an example, put in 10,000, and the cash value only shows up at 6 or 5 or whatever, depending on how it's designed. And so those first 3 years are difficult, I guess I want to say, in that you have to have the ability to have the long view, right? Thinking long term. And if you can get past that, which I am happy to say that we are getting past that. We're past it with my wife, and we're getting past it with mine that I just started. But it's just part of the process. But when you're going to be creating, or you're going to be using somebody's banking function anyway for years, whether it's yours or someone else's. You're going to do it for 10, 20, 30, 40, whatever it is, years. Why not have it be your bank? But you just have to be patient and get past those first few years, the
Mm-hmm.
startup years.
Yeah, and it's not all bad. Those first startup years, you can use
Right.
it. It's not
Yep.
like it's this complete drain. No, there's a learning process, but it's still available to you. You can learn how to bank. You can learn how to do everything by taking action in those first even years. In the first month, you can do it,
Yep.
but it may not just be as profitable or as efficient until several years down the road, which is
Yeah.
fine and good.
Yeah. Yeah. We did it. We did that. Like I believe it would be Nelson that used to say, you years 1 through 3, you're starting it up.
Hmm.
Um, but not necessarily to take a loan or whatever to do something, but we did. First year, right out of the gate, we built a new fence and financed it, and with the bank, the policy loan, and then paid it right back within a year. So
That's
yeah,
awesome. It's awesome. So let's
yeah,
talk about the way these policies are designed. And for all of our listeners that are checking out on the podcast with audio only, I want to paint you just a quick word picture, and then say you should probably just go to page 38 of Becoming Your Own Banker, because he's actually got a diagram in there. But just imagine you've got, a line, and on the left side of that line uh, you've got the ultimate policy for banking, and then on the right side you have the worst policy that you could use for banking. Well, on the left side, that best policy, that's single premium life insurance. You pay once and it's done. You have immediate equity in everything. Now, on the right side, the worst one is term life insurance, because you're renting a death benefit. There's no equity that ever builds in these things. And then you've got
right.
several things in between. You've got ordinary life, which would be paid up until age 100. And then as we get closer and closer to the left side, getting better and better, you start shrinking that payment period. So instead of paying out to 100, you're paying out to 75, 65, maybe a 10-pay policy. And the goal is to get as close to that single premium. Well, let me back up really quick. Single premium life insurance policies are taxable. They're created, I should say, in the 1980s. The IRS came in and said, okay, single premium life insurance is being treated more as an investment. And so if you're going to do that, if you're going to get a single premium policy, then any use of that, any policy loans, are going to be taxable. So they created a kind of line in the sand that is, it's called a modified endowment contract. Anything to the left of that that's closer to that single premium life insurance policy is a modified endowment contract, and will be treated as a qualified plan, basically, when you're utilizing it. Anything to the right of that modified endowment contract line can be utilized for banking. Now, we want to get as close to that MEC line as possible, because that's where the efficiency lies. Raymond, do you
Yeah,
have any stuff to add to this as we're going?
yeah. We want to, as he says in the book, we want to snuggle up to it. We just don't want to cross over it. I mean, if you don't have to, it's better for you not to. So when the policies are designed by an IBC practitioner, that's what they're avoiding. They're snuggling up, but not crossing over.
Yeah. And there's different philosophies when it comes to how long do you pay for your policy. One of the philosophies is, I want to capitalize for the rest of my life. And then another philosophy is, I want to capitalize for 4 or 5 years and then just use that policy, set it and forget it, and then move on to another banking system. Neither one of those are wrong. I think it's important to understand what it is that you're looking for in a banking system, and what it is that you and then like picking an advisor that will help you navigate what might be best for you. Because just before we turn the cameras on, Raymond and I were talking about the similarity between this and like establishing a chain like a McDonald's. You could capitalize that one branch for the rest of your life. You could pour money into it for the rest of your life and never expand from there, and you'd have the best restaurant in the world. But if you take it and say, I'm going to invest in this for the next few years, and then once it's self-sustaining and it's really good, you're utilizing it, you're providing a benefit to people around you, then you're going to go establish another branch to your McDonald's business, and just keep going and going and going like that. Those are completely different approaches to business. And one is right for a certain type of people, and the other is right for a different type of people. So when you're picking your advisor, making sure that you're sharing what it is that you're looking for with infinite banking, what your goals are. That's important for them to help you get the right kind of policy, because it's a different design.
Yes, right. Yeah, lots of times people will tell me, uh, I'm not really interested in the death benefit side of things. And then I'm like, okay, well then we'll design it this way. Creating more cash value sooner, faster, because that's what they're really after.
Mm-hmm.
Yeah,
Yeah, and
we'll
so
need
there's
a
there's two different elements, primary elements to a life insurance policy designed for infinite banking. What we've been talking about, the single premium versus the term, this is all relating to the whole life policy. The base is what a lot of us in the industry call is that's your foundation or your base. And then you have PUA, which is paid up additional life insurance. That the funds that go into PUA they generate a lot of the cash value in the early years of the policy. There are different schools of thought within the infinite banking world. I don't remember if we've already recorded a podcast on this, but some people will lean more towards 10% of your total premiums. Let's say you're going to put $100,000 into a policy, $10,000 goes into the base and $90,000 goes into the PUA, so that you have access to $85,000 in year one, because everything's going into that PUA, or maybe it's close to 90,000. It's close. The problem with that is it's really efficient in those early years, but the base policy that we've only put 10,000 to, that's not a large percentage, and that's what carries forward a lot of the growth and health and stability of the policy in the future years. So it's important to have a balance. Some people will go more of a 50-50 blend where they'll have 50% to the base and 50% to the PUA. And if you look in the examples that Nelson laid out, he's like 37.5% to 40%. It's right in there that goes to the base, and the other 60% that goes to the PUA. And so that's the way, his approach was 40 to the base, 60 to the PUA for most circumstances. I'm not saying that there's not circumstances where that shouldn't be the case.
Right. Yeah. 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 So it just depends on what somebody's wanting to get to. Mm-hmm. Right.
Yeah, and then there's the other element, and this is why I tell people, hey, maybe don't get too caught up on that 90-10 stuff, 10% going to the base and 90% to the PUA, because you talk to people who have been in the industry long enough, I'm talking 20 to 30 years, and they're doing what Nelson did in purchasing more and more policies because they're making more money, or they've got more insurable interest, or whatever it might be. They're getting more policies. A lot of these guys, after they've already got their first 10 to 20 policies, they're purchasing policies that are 100% base and no PUA. People ask why? Well, because they don't need the liquidity. They've already created such a great banking system. They don't have to put money into PUA anymore. They've got everything they need. They want their dollars to be growing as efficiently as possible, and that is by the way that you get that is by putting the money into the base, into just a whole life, straight whole life, healthy whole life policy. And it takes off. It takes several years to take off, but once it takes off, that sucker's a juggernaut. You can't stop it. It's beautiful. So that's why, when I'm approaching anything, I always want to think, okay, what are the people that have been doing this for 30, 40, 50, 80 years? What are they doing? And why are they doing that? And let that inform what I'm doing today, even if that means I got to pay a little bit of a consequence, or I might have to sacrifice a little bit of something in the earlier years.
Yeah, a little bit of time, maybe.
Yeah.
Which is a serious consideration. When I designed my particular own policy, I was after a large death benefit right out of it, as much as I could get. So I went like 80-20. And I just think, I'm not in a rush to get the cash value, but it comes back pretty quick. Mm-hmm. and really does, as you have mentioned, it does start to really take off. In not too far distance future, 7 years down the road, it's cranking. So,
Yeah, that's
and
awesome.
yeah, yeah. Uh, so what do you make of this? Where he says paid up additions rider on an ordinary life policy is like overfunding the policy.
Yeah, basically, you're paying more than you have to pay. That's all. You only have to pay that base policy. In the example we were talking about before, 40%. If you've got $100,000 policy per year, 40% would just be $40,000. Anything above that $40,000 mark is overfunding the policy. Anything that you're overfunding, you have access to because you've got immediate equity in it.
Mm. Yeah, I like that word. Using that word um, reminds me of my home.
Equity.
Yeah. Except for my home, I've got a lot more hoops I've got to jump through to actually get at that equity.
Yeah. And sometimes it goes up and sometimes it might go down. You
Mm.
don't know,
Yeah.
based on the market systems, based on like so many different things. The cool thing with life insurance policy is once you have the equity in there, you literally can never lose it. It only
It
gets better.
never goes down.
No. That's why I
Yeah.
tell people, hey, don't worry about like overpaying your mortgages because people are so eager uh, to get rid of their debt, to pay off their house. They want to overpay their mortgage. It's like, okay, so if you want to ever have access to that money, what do you got to do? Well, you got to go take out another mortgage and restart the whole process. So why don't you just take that money and put it into a system where you have access, because you're always going to have a house bill. You're always going to have a house bill. It doesn't matter what you dream.
Yeah. 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 Um, well, there's a neat little story. He talks about this Christopher Columbus, right?
Yeah.
Started the journey westward, and they were going to India. But when they arrived, obviously didn't arrive in India, but they called them Indians, and they weren't. But it stuck, and there again, there's the classification
Mm-hmm.
of it all, misclassification.
Yeah. And so the way they thought of them was Indians because they called them Indians. And so they have always been called Indians. I mean, now, the politically correct term is now Native Americans, but many people still call them Indians, right? And yeah, they just stick. Words are powerful.
Yes, yeah, and a lot of times the first word that is used to describe something sticks.
Mm-hmm.
Everybody starts to use it because they don't have some other word to use for it. But
Yeah.
do you want to talk about his thoughts on universal, or do you want to cover some more on this line here that
Well, I feel
you
like we
know?
did a pretty good job covering that. What are your thoughts?
Yeah, I do too. I mean, for those that are just listening, yeah, it's on page 38. Um, Take a look at it, and you'll see the triangle snuggling up to the mech line. Um, but his thoughts on the universal life. Do you want to talk a little bit about
Yeah.
that?
Yeah. The reason why I wanted to talk about it, and we've covered universal life on a previous episode, so I would encourage anyone to just go hop over there or maybe just shoot us a call or whatever. But I do want to touch on this really quickly because it is in the section about creating an entity, and he shows how universal life, um, basically, the purpose of it was to like not reallocate, but remove the risk from the life insurance companies and place it back on the policyholders. And the benefit that they gave the policyholders in exchange for that horrible deal was that they'd be able to leverage the values in there in an index or in the market, right?
Right.
With a index S&P stock, whatever, with a happy culture towards those kinds of things, people bought it. People buy into universal life because they think, oh, the stock market or the equity market or equity market. That's not right.
Call it the stock market, the index, the indices.
They think that's where all the good stuff is, or it's where the excitement is. Really, it's just a gambling machine, and nothing's guaranteed there at all. But it's so intoxicating, it's so exciting that people will buy the incorrect vehicle that puts more risk on them so that they can have a perceived benefit. When you're in the process of banking, you don't want to do that.
Right. Yeah, the bankers are very conservative, and so should we. You can go off and into the indices on your own after you start up a policy with real whole life. There's no reason to add it to your life insurance policy.
Yeah, there's nothing wrong with all that other stuff. Go do it. Go have fun.
Yeah,
if that's where your skill set is, go do it. If it's not where your skill set is and you just want to play the Wall Street game, then go do it. But don't do it with the same vehicle that you are banking with, because that is sacred and it needs to be treated as such. So just stay away from universal life, variable life, all of that.
Yeah.
Don't get intoxicated by the great illustrations and everything else that goes along with that.
Right. Yeah, because it does illustrate better, so it looks better, and it's classified as whole life, under a whole life, and so that can be very misleading. That you can go ahead and use these universal life, variable life with Nelson's concept, becoming your own banker, and that's not good advice, in my opinion.
Yep. Well, sweet. I mean, that's all my thoughts. Do you have any parting thoughts before we cut it off?
No, I don't think so. He does. I just will say, because I love to read, so I'm always looking for books and such. And he mentions The Pirates of Manhattan by Barry Dyke, and that's really about what the problem is. Anyway, I would just suggest that people read the books on page 39 and the last third to the last paragraph. He mentions these books. You might want to go check one or two of them out and find out what's really going on in the financial world.
Thank you for joining us on the Sound Banking Podcast. If you're listening on YouTube, make sure to like and subscribe and click on the notification bell. Otherwise, join us on Apple Podcasts and Spotify for more content.